Okay, I don't want to keep everyone waiting too long. So we'll go ahead and begin and get through the intros, at least before we get to the discussion. Again, thank you guys for joining us today. For those of you who don't know me, my name is Lena Dobreer. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. We are member-based. Our members consist mainly of private equity professionals, investment bankers, lenders, independent sponsors. And we have various chapters, LA, Chicago, and New York, where typically we'd be doing a finance seminar or a panel or a roundtable in each of those markets once a month. But given that everything is virtual now, we're here with you today in this way. In addition to those monthly events, we do deal sourcing events, again, typically all around the country, but now typically all over the internet. So I think we're in 16 different markets. Many of you are participating in our San Francisco Deal Connect event today, where we're pairing up capital providers and investment bankers for one-on-one meetings. So thank you for participating in that later on. If you guys have any questions about who we are, what we can do, how we can help, reach out to my colleague, Jacob Zeffrin. His information is down below. He'd be happy to answer any questions that you may have. During today's discussion, our moderator, Pradeep, he will be monitoring the Q&A. So as questions come to mind, there's a Q&A bubble at the bottom of your screen there. Go ahead and submit it there. Please do not use the chat function. Use the Q&A button down there. Pradeep will be looking through those, and we'll get to as many as we can. Of course, these events would not be possible without the support of our sponsors. So I definitely want to give each of them an opportunity to say a few words. Steve, I saw you in here. I'm going to go ahead and unmute you. Steve, please introduce yourself and your firm.
Good morning. Thanks, Lena. My name's Steve Finder. I am a managing director with Focus Search Partners. I'm based in California. We have offices throughout the country, and we cover heavily focused on doing retained executive search work for portfolio companies for lower to mid market and some large private equity firms. I lead our technology practice. We've got a technology practice, aerospace, defense, industrial manufacturing, healthcare services, and some consumer and also business services. And very pleased to be here as always, and look forward to a great day. Look forward to getting to know you.
Sorry, thank you, Steve. Longtime supporter and dear friend of Opus Connect, Jim Davidson of Avant Advisory. I see you here. Jim, go ahead and introduce yourself and your firm, sir. Jim, you'll need to unmute. There you go.
Thank you, Lena. My apologies.
No worries.
I want to thank you for having us here. Love Opus Connect. I'm Jim Davidson, President and Managing Director of Avant Advisory Group. I won't repeat everything that is said right here. You can read it for yourself, but we work with investment bankers and private equity firms, been involved in doing primarily Q of Es, many on behalf of investment banking firms, sell side and buy side diligence. My associate, Joe Aloof, is right there in San Francisco. He's got a tremendous career, a stellar career in restructuring and distressed and operational turnarounds and financial restructurings, and not to mention Q of E, a deep, deep experience. Joe's a lot older than me, I might say. No, I'm kidding. We've been around a while, so we've seen a lot, and we love working with investment banking firms. I think that's it.
Thank you so much, Jim. Next, we have Sapient Investigations, David Kogan, one of the original sponsors, and of course, a dear friend of Opus as well. David, please go ahead and introduce yourself and your firm.
Thanks, Lena. Hi, David Kogan with Sapient Investigations. We're a international corporate intelligence firm in the private equity space. We primarily specialize in executive background checks. We look at management teams, joint venture partners. We work with large commercial lenders. pretty much every category you can think of. We also have a robust business dispute practice, and we do a lot of interesting work around sort of benchmarking and litigation. So anyway, looking forward to meeting more of you as the day goes on, and thanks for having us, Lena.
Thank you, David. Next, we have Cone Resnick. Natalie, I see you in here. Please introduce yourself and your firm.
Good morning, everyone. Thank you, Lena. My name is Natalie Tronchina, and I'm a partner in the Transactional Advisory.
Uh-oh, my apologies. I think I clicked something on accident.
Can
Natalie,
you hear me now?
Yeah, apologies.
Yeah, perfect. Good morning, everyone, again. Yes, so I am a partner at the Transactional Advisory Services practice of Resnick, and Resnick is one of the top accounting firms in the United States providing audit, tax, and advisory services. We focus on nearly 24 of industries, including technology, healthcare, cannabis, manufacturing, distribution, consumer products, business services, and real estate. And the service businesses ranging from multi-generational family-owned companies to publicly traded companies. We work closely with business owners and management teams who are seeking guidance regarding acquisitions, divestitures, and capital formation transactions. And as a member of international network called Nexia, Resnick provides services to clients in more than 100 countries around the globe. We're excited to be here sponsoring this great event today and looking forward to meeting and chatting with everyone later today. Thank you, Lena.
Thank you, Natalie. Next, we have Hanson Bridget. I'm not sure if we have anyone in the room with Hanson. If you are in here, go ahead and raise your hand quickly, and we will try to navigate to you. But Hanson Bridget, they usually would be hosting us in their San Francisco office today, but given the virtual nature of our current climate, we will acknowledge them here. Okay, awesome. And last but not least, of course, ContinuServe is also a sponsor of today's event. Thank you for that support. Pradeep will be moderating today's event. And just before we get to him, we do have a question for you all. We'd like your participation here. We're going to go ahead and launch it. We'd like to know who you are. Independent sponsor, capital provider on the debt or the equity side, investment banker, service provider. Let us know. This is a good kind of baseline for our panelists to know as well who they're speaking to today. So we'll give it about 20 seconds there, and then we will move on. Okay, so it looks like 5% independent sponsors, 38% investment bankers, some capital providers on the debt side, 24% capital provider on the equity side, and some of our sponsors as well. So thank you guys for participating in that. Without further ado, I would like to introduce today's moderator, Pradeep Khurana of ContinuServe. Pradeep, go ahead and take it away. Excuse me.
Yeah. Well, thank you, Lena. Thank you for helping put this together, and also thank you, Opus. We're new to these events with Opus, but we've really been enjoying it and really appreciate the opportunity. A little bit about ContinuServe. We provide back office solutions to mid-market companies, and what that means is we provide the systems that are used to execute back office operations, so financial systems, budgeting systems, and we also provide the services to complete those back office functions. So we actually do accounts payable, billing, all of those things that need to get the back office work done, including general accounting. So it's almost like a back office in the box service. And we do a lot of work with carve-outs specifically. So when a divestiture happens, rather than rebuilding a whole back office operation, a lot of our clients sign up with us and we provide those services, which is, over the last few years, I've gotten a lot of terrific experience working in the carve-out market and really Looking forward to participating in this panel with our panelists who have some terrific experience in this area. So with that said, I will introduce each of our panelists, and we'll start with Emily Golenberg from Platinum. So Emily, please introduce yourself.
Thanks, Pradeep, and thank you, Lena, for organizing this event. You can see a bit of my blurb on screen, so I'll keep it brief. I'm a vice president with a financial sponsor, Platinum Equity, with which many of you may be familiar. We currently have 23 billion under management, and we're investing out of 2 of our funds right now. We have a $10 billion mid and large cap fund and a $1.5 billion small cap fund. I specifically am responsible for all of the carve-out aspects of our diligence for any of the divested assets that we're looking at. So for both of those funds, small cap and the mid and large globally. Prior to joining Platinum, I was with KPMG, where I was responsible for both diligence and execution of both carve-outs and integrations. Pradeep, I'll hand it back to you.
Yes, great. Thank you, Emily. And next we have Nate Aslesen from Hallum Capital Group.
Yeah, hey everyone. Hey Pradeep, thanks for the intro. So I'm Nate Aslesen with Craig-Hallum Capital Group. We're a full service investment banking firm, actually based in Minneapolis, but have national coverage. We've got a few folks in San Francisco, all the way over to the East Coast as well. So, our business, we're an investment banking firm. We have kind of full service in the sense of, cover both public and private companies. We have equity research, institutional sales and trading, and then I reside on the investment banking side where, it could range from capital raise transactions in the public domain. I tend to focus more so on private, typically private company M&A. That's been my background, from founder family-owned businesses, private equity-owned companies, and then corporates doing carve-outs. So I've done a number of carve-outs. Some on the smaller end that are easier, simpler, kind of standalone businesses, and others that are more integrated and trying to navigate, how to peel the business out and standalone financials and, one-time costs and trying to position the business in the market as a sell-side advisor. So that's kind of my background at a high level and in our firm.
Thanks, Nate. And next we have Tom Henderson from Capital Access Partners. Tom, I'll hand it to you to introduce yourself. You might be on mute, Tom, so you might have to unmute it.
All right, is that better?
Yes, we can hear and see you.
Thank you. So start again. Good morning. I'm Tom Henderson. Capital Access Partners is an advisory practice that I started about 4 months ago after leaving Accord Financial, where for many years I was the CEO of the parent company. And in that business, we financed several dozen, over 3 dozen carve-outs from major corporates by typically independent sponsors. My business now is to advise middle market and lower middle market borrowers on their solution, their solution, capital solution needs, whether it's debt or equity. I'm the guy that would be engaged when they're in a hurry, either because there's a crisis of an opportunity or perhaps a looming liquidity crisis. So I'm happy to participate in this panel and talk about carve-outs. Thanks, Pradeep.
Thanks, Tom. Really appreciate it. So, it's a terrific panel with lots of varied experience, in the carve-out world. So I think one of the, the theme of this panel is really prompted by, the expected volume in divestitures that are, that we believe will happen somewhat because of the economic cycle we're naturally in, but also perhaps, the COVID situation being a catalyst for larger companies, needing to focus on their core specialties and maybe getting out of some business lines that they were thinking they might expand into, but now, they may not have the resources for. So we are expecting, and we are also seeing some large increases in the number of carve-outs in the market. One of the big challenges is that, while the business is still part of a bigger corporate entity, it's sometimes difficult to figure out, what does the standalone business look like? So there's a lot of, it's a bit opaque. There's a lot of sometimes difficulty in figuring out, are you buying something that's, going to end up being a fantastic investment, or are you going to be stuck, with something that's going to be a time sink and a money sink and very difficult to ever get a good return on? And that's a big challenge with carve-outs. So I'd like to direct the first question to Emily. Emily, you told us at Platinum you do a lot of work on the front end, on the diligence end, and I'd like to ask you, what are some of the first things you look at when evaluating a divestiture, to purchase for Platinum? So what do you look at when you start taking a look at a deal? Sorry, Emily, you have to unmute.
I'm on mute. Yep. I followed the instructions well. I just forgot to take myself off. So I'll preface this all by saying that I basically, in my role, I consider myself to be a bit of a detective. And what I'm looking at is, so what we start with, and I think many of you will be familiar with this, we'll start with whatever materials are provided with us by the seller, typically put together by advisors. So we're looking at an FDD or a VDD package. And what I really want to understand is what have the advisors done versus what have the management done? So I will assess, what we're being told, and then I want to understand what the truth is. And I do that by really kicking the tires on all of the diligence and looking for the gaps, looking for whether the pieces hang together, where the gaps may exist, and how well the management team really understands what they're presenting. Because often what we find is, as I think we're all familiar, a lot of the sales process is very much a marketing process. And they're trying to present the best packaged version of the business. But that often, as the title of this section is, there's a bit of putting lipstick on a pig sometimes. You're dressing something up, you're putting pieces together that may not necessarily hang together. So I view my job as really understanding what's underlying the packaging. What is consistent, what's not consistent, where are the gaps between what we're seeing and what we're not seeing. And as an example, I just came off of a call with a target management team where they are presenting to us their view of what post-standalone looks like. As it turns out, what post-standalone looks like in their mind is keeping the business going on a bunch of service agreements to get to standalone at some point, but they've never really looked at the standalone piece of it. So as I started pushing through and asking them questions, it became very apparent that they hadn't thought about how they'd actually run this business on a standalone basis. They would tell us that the costs were representative, but then when push comes to shove, we find out that it's really just, they've really just maintained an allocation basis. So what they're presenting as standalone is actually not very much a standalone business. Or I'll start asking questions around if it's a highly regulated business. Have they thought about the regulatory implications that may occur based on the transaction? So really what I want to understand is what is actually coming with the business, how well versed the management team is in what they're presenting, and how well they're prepared to run this business on a standalone basis. And so there's maybe a discrepancy between what the advisors say, what the management team says, and what the corporate development team has done.
Great. That's some great perspective, Emily. And I just want to, you were talking about, viewing it from the buy side in terms of how the deal was marketed and packaged. So I'd like to get the next question to somebody who markets and packages the deals, which would be Nate. You know, when you are, you know, when you work a lot with corporations that are looking to divest. And from that perspective, what do you look to highlight when you're presenting a deal?
Yeah, I mean, I think, you know, kind of on the flip side of it, I think my view of it is from a seller standpoint, you know, particularly for carve-out, given the complexity that inherently exists in them, and I think the level of diligence that's required in any deal, but I think even more so in carve-outs, you know, for me, it's really trying to be really, really prepared, because all of that stuff, as Emily said, is that it's going to be uncovered, you know, through the diligence process, and the seller is far better. They're going to be far better off. The process is going to go far smoother if we've kind of helped to aid in, you know, in sort of manifesting that work product, you know, and so we'll help kind of be the quarterback of a lot of that work. But, you know, we want to bring in third parties, you know, where necessary to help evaluate that, whether that's going to be IT or if it's going to be, you know, healthcare, right? What are the benefit plans? How are those going to be transitioned? You know, so I think there's a couple of things. One, you're sort of marketing the business on the merits of the business itself, right? So for example, recently carved out a food manufacturing company, really great sector. You know, they manufacture product for big CPGs as well as smaller brands, and, you know, really, really nice business, but it was part of a large corporate parent where it just wasn't the right home. And so I think the carve out market presents opportunity for those that have a strategic or financial reason to say, this is a market I want to be in, and carve outs can present a lot of opportunities. So we try to present it on the basis of the business itself, the market that they're in, the customers, all those things are positive elements that we try to present. But I think it's also combining that with the rigor of diligence that we know is going to be required in these kinds of deals. So, you know, I think another big part of this too is educating the seller, and a lot of it will depend on who the seller is. You know, have they done a carve out before? How sophisticated are they? Do they have the internal resources to help transition, you know, a business? You know, have they done a TSA before? Do they understand how to navigate that process? So, you know, I view our job, you know, on the as the inverse of Emily's, where, you know, my view is that we got to be overly prepared to, you know, for success and maximizing value. And also, once you get under LOI, your leverage changes completely. So you kind of have to have a lot of that stuff vetted out, where the buyer knows what they're getting into. So there's not going to be some massive surprise on, you know, okay, the what we thought is very different, or there's, you know, it's going to require massive stand-up costs to, you know, extract the business out. So, you know, we try to be as prepared as possible, you know, and certainly buyers have different views of, you know, whether they want to integrate a different system or other things. So there's always going to be that tension that exists, but trying to be prepared for it.
Thanks, Nate. That's really helpful. The next question I'll direct to you, Tom. So your perspective is a little bit different, because I understand you work a lot with independent sponsors. So, you know, maybe talk to us about how it is working with that group of buyers as opposed to, you know, a typical financial buyer that may have a dedicated fund. Would be interested in understanding that a bit more.
Well, it's not easy for them because, first of all, they're starting off being recognized as likely not having committed capital, which they typically don't. That's the definition. They're independent. And so they're working hard from the very beginning to establish credibility, to explain that they know how to do carve-outs, how to negotiate and finance and manage them. If they have the history of having done that, they certainly want to bring that out early on. And also they want to make a commitment that they can do it in a faster way, perhaps, than a sponsor with committed capital or a strategic, because they are more entrepreneurial by nature. That being said, they have to start to do their analysis while they're still ingratiating themselves with the investment banker or the seller or both. And they're trying to balance all of these issues at the same time, including determining if they are successful in getting the exclusive and they like their due diligence and they're happy with that process, how they're going to actually finance this carve-out, given the fact that by their very nature, they don't have a lot of capital to commit to it. So this is a chore for them. And then they got to do all the same things that Detective Golenberg has to do. And they don't have her experience for it in many cases. So they have to call in experts to help them, and they do that from time to time. So most of the carve-outs that I've seen with independent sponsors have been people who have been buying relatively underperforming units of major corporates. Underperforming for a variety of reasons. Usually it's been ignored or it came along with some other acquisition. They got this, what is it? And nobody owns it, and it becomes an embarrassment. It's not losing money. It's losing money. It's not generating cash flow in many cases. That means two things. You know what's going to happen. They are going to sell the business. It's not like a private owner of a business and they're going to change their mind because the grandma doesn't like it. They're going to sell the business. Secondly, they're not that focused on price because remember, it's a small piece of a big business in most cases. I'm talking about when the independent sponsor is coming in and buying a lower middle market company, it's a small piece of a much bigger pie. So their focus is on just getting it done and reporting to the shareholders, we sold that thing because they've already deemed it non-core. So the independent sponsor now has the advantage if he's established or she has established their credibility with the seller and the banker. Now they have an opportunity to put together a deal in a hurry if they can prove that they move fast, but they still have to do all of that work. They have enormous deal costs. I'll stop there, Pradeep, because there's a lot more to the story.
No, that's super helpful. I mean, if you like, it sounds so attractive in the sense that, you know, like you were just saying, you have a seller that's definitely going to do the deal and they don't care about price. But the wrinkle is it's like an underperforming unit. So, you know, I think that's really like, you know, having the guts to actually go and do a deal like that is, you need a lot of courage for that, I think. But you do have some of the, you know, some great conditions for making a deal happen. So I'll just stop for 1 second and say we do have this Q&A function in the Zoom. So, you know, people who are participating, I see there's a bunch of participants. Feel free, if you guys have questions, I'll be happy to pick them up and direct them to the panelists. So I just want to make sure everyone's aware of that. But you know, I do want to just kind of circle back with some questions here. And I'll leave this to any of the panelists to address. But, you know, maybe I'd be interested in finding out like a situation, just, you know, going back to the theme of this panel, where there was a deal that came across and you thought it was a diamond in the rough. It was an underperforming unit that, you know, once carved out, could really perform very well. But that didn't turn out to be the case. Okay, it ended up being something that maybe you got a return on, but only after a massive amount of effort and investment, or it's something that didn't turn out well at all. So I would like any of the panelists to tell me about an experience like that. And if you could go back in time, what is it that you missed or you would have changed? And I'll open it up to Tom, Emily, Nate. Any of you guys want to respond to that?
I'll just give you a quick reply, and I think Emily has a lot to say on that subject. But what I've seen on numerous occasions is the failure to manage the execution risk that's inherent in buying a business that is not performing the way it should be. It may mean consolidating locations. It may mean adding a different marketing aspect to going to different channels. There's always something that has to be executed. These are not perfect businesses. Otherwise, maybe they wouldn't be for sale cheaply. in the examples that I was speaking about. So I have seen sponsors really underestimate the risk in executing their plan. And it's always, this is how we're going to get the EBITDA margin to X, because we're going to be doing this. And somebody who's advising them has to say, can you really do that? Do you know that the risks that are inherent in managing that? And a lot of sponsors, God bless every one of them, have a lot of optimism. And sometimes somebody has to, like Emily does occasionally, I'm sure, has to bring the people together and say, look, do you really understand the issue that you're facing here? It's one thing to write it down on a piece of paper. It's another thing to actually execute that. And are you really committed to making sure that that works? So the mistakes that I've seen have not been that they didn't know everything that they should have known. It's just that they had optimism that was not warranted about executing certain aspects of their plan to make the business clearly valuable.
Yeah, and I'll add to that. And one of the things I didn't mention in my intro, what makes Platinum unique among many of the financial sponsors is that we do, not only do we have a reputation for buying carve-outs, but one of the reasons why we do is because we have a large diligence and operations team in-house, and we have an interplay between the two. So we are very much where Tom was talking about optimism. I would say because of our experience, we are probably, our optimism is a bit tempered. We have the scars. We've been to the war before. We know where the pitfalls have been, but at the same time, we also know what we can do. And what I would say is, well, I think the market's changing a bit. I think it's still very competitive. So, you're less likely to get an asset on the cheap these days, which means that it's even more important that you manage all the execution risk, all the operational risk. And I think, we'd break it into a couple different parts. There is the underperforming piece of the business, understanding why it's underperforming. Is it because it's just been underinvested or because the market's shrinking? So there's that one piece of it, but you need to bring the business back to health at the same time you're standing it up, which is a big change process. So, going back to the management team, does the management team have the capability and the stomach for it? And I one of the questions you asked Pradeep early on is, an example of where something may have looked more appealing in the diligence phase, and then for whatever reason turned out to be less it provided a less return than anticipated. And I can talk about one of the diligence processes I worked on, where I will say it does actually have a happy ending in that we did manage to turn around the business and get where we needed to get. But it was a bit of a struggle, in part, going back to something that Nathan said earlier around the preparation of the seller. And in this case, the seller appeared as if they had prepared. We knew they hadn't, based on the diligence. They were very inexperienced divestor, and they really just did not understand the operational implications of what they were doing. They did a financial exercise, and they thought that would easily translate. So what that meant for us in the, once we became owners of the business, is we realized that there were a number of areas where they just did not recognize the challenge of what they need to do. So we're very, very experienced, as I said, in standing up businesses. But when you have a partner who's not very experienced at, for example, servicing a TSA, or even knowing how to engage in talking to their people. So in this case, we encountered a number of challenges. Firstly, we found out that they had misrepresented their piece of, it's a highly regulated business. They had misrepresented some of the regulatory standalone considerations. And it's something that we discovered just as we were signing the deal. We managed to get them on the hook for some of the costs, but it ended up being a very heavy lift and quite a distraction. Another piece of it that really created a challenge was, I mentioned TSAs, that they didn't realize that they needed to tell their people that they needed to sell, that they needed to continue providing services. So we're paying them for services. The people who are meant to be providing the services think, oh, we sold the business. That's great. Now I only have to do 80% of my job. I don't have to do 100% of my job. And those people are dispersed all over the world. So we start realizing what's happening when the services stop happening. So that becomes a big distraction for the team, where they're trying to stand up a function. Now they're just trying to keep the business afloat, trying to keep the services going. So that's one piece of it. So we've got, we find that we have a big standalone cost gap from a regulatory perspective. We've got TSA service implications. And then the third piece, and this is all why you're trying to bring the business back to health. And then the third piece is, and an area that often gets overlooked because it's much harder to diligence, is culture. So then you find out that this team that has presented themselves as being very competent through the diligence process, and they've been very well prepared, like by the investment banks, and they can speak to all the information. When you find out, once you own the business, that they're actually not, once they get off script, they're actually not as effective. And in fact, that may have an implication on the individual. So you're trying to turn the ship around, and you've also discovered that you've got to turn the culture around as well. But if you can achieve all those things, then you can realize, but it goes back to understanding when we talk about execution risk, there's so many different elements to that.
Wow. That's, yeah, I mean, it's just imagining all of those considerations, on top of a typical M&A transaction. There's just so much more, you have to think about and think about mitigating. When you guys are, and I'll put this out there for anyone, but like when you think about the management team for the new entity, for a carve-out, are there, whether they're coming with the deal or whether they're going to be installed afterwards, are there specific characteristics that are important for that management team that are, especially relevant when you're doing a divestiture or a carve-out? Are there specific characteristics you look for in terms of a management team? And I'll let any of you guys, if you want to talk about that.
Yeah, maybe I'll comment a little bit and then maybe pass it to Emily or Tom. I mean, I think going back to what Emily was saying, I think that understanding where the gaps exist, because I think, within a big corporation, a lot of the metrics and the way that a business is measured may be very different, in a lot of instances, to what the business would look like outside of that corporate or outside on a standalone basis or whatever. So for example, within a big corporate entity, they may be measured on a very different level of kind of, cash, right? So cash and sort of working capital, there may be just different measures versus sort of EBITDA and true cash flow, and profit generation. So there's just differences in terms of how management teams may be incented in a corporate environment versus what it looks like outside of that. So I think understanding what those parameters look like internally, and then what the capabilities are of the management team, when you get outside of that, and where the gaps are. Do they have experience working in a levered environment? Do they have, just different things like that I think are critical aspects to, how is the business being managed today from a financial standpoint, and then even in addition to that, it's sort of systematically, what's the reporting structure? What metrics are people based off of from both a financial and business standpoint? So I think, buyers really understanding the capabilities of the management team is really, really critical. And identifying where they're going to need to fill those gaps, either in an immediate role or in a transitional capacity, I think is really important.
Yeah, thanks, Nate. Tom or Emily, do you guys want to chime in on that?
Sure, I can add to that. And I think it's also helpful to put it in context. We're talking often the carve-outs are underperforming subsidiaries of larger conglomerates. So you have a management team that has basically been probably in harvest mode for a number of years, and all of a sudden, the thesis for a lot of these deals is growth. So once it gets the attention, this asset gets attention, it gets some investment of capital, then they're able to, the presumption is that they'll be able to execute on a growth plan. And one of the things you need to think about is, in keeping with what Nate was saying, is, does this management team have the capability to take this business forward? Do they have a vision? Do they understand, as he said, the underlying levers of the business, but do they also have the leadership capability to run this business, because they're essentially getting battlefield promotions? And can they actually take this business where it needs to go? Can they speak to the growth plans? Do they understand the market? And do they understand, you know, back to what I was saying before, the complexity and challenge of what is required to actually stand up the business? Do they actually understand what that requires? Do they know what they need in their team to run a business successfully on a standalone basis?
Oh, that's really that's very helpful. We do have a question from the audience. I'll read it out loud, and I'll direct this to you, Nate. It says, the question is, we have often seen in carve-out deals that the parent seller really doesn't understand the business they are selling, and that's one of the reasons they're selling it. And they dismiss the real issues that the buyer needs to run the business independently. They just attribute it to the fact that, you know, it just needs to be carved out. Have you seen this as well? So, Nate, I'll give that to you.
Yeah, I mean, the short answer is yes, you know, absolutely. I think that's in part where our role is really important, is trying to help kind of manage that tension that exists between seller, you know, it's weird, right? On the one hand, sometimes sellers, you know, the reason that they're selling is they don't understand it, it's non-core, it hasn't been performing as well. Yet on the other hand, you know, there's elements where they sort of make it seem easy, as though it's going to be easy to turn around, right? So you're kind of inherently dealing with a little bit of that conflict and tension, but, you know, it's our job to try to be, I mean, my view is just, you got to be very fact-based. You know, you try to be as fact-based as possible, you know, around what is, you know, what are going to be the challenges in the deal. And that happens very, you know, that happens up front. You know, so, you know, whether it's, okay, the business is going to, it requires a lot of capital to get this thing turned around. Okay, well, that's going to factor into purchase price ultimately. What's going to be required as an investment to, you know, really get the business, you know, on a standalone basis. All that stuff gets factored into purchase price, right, ultimately. And so, you know, I think it's just, you know, it's our job to try to navigate those as best we can. And there's going to be different levers that are going to be important to the seller. And then there's other levers that are going to be more important to the buyer, and trying to navigate that the best way you can. But it's definitely a real issue where, you know, they don't sort of fully understand some of the issues or what's going to be required to really turn the business around, right? And the term I use is sort of, what's the degree of the lift? You know, how heavy is the lift? And helping, you know, the seller really understand that this is what the market is saying as it relates to the feedback on what this is really going to look like.
Yeah, no, that's really helpful. You know, Nate, just as a follow-up, you know, you have folks like Emily and Tom that have a lot of experience, you know, purchasing or being involved with carve-outs. But there's probably a lot of people who are on this call who might not have done one before, either in an advisory capacity or as a purchaser. Like, if you were giving candid advice to a first-time purchaser who's looking at a carve-out, what would you advise them? What would be maybe the top 3 things that they should do?
You know, I think the first is really understanding the business and the market that you're looking to get into, you know, and do you have sort of a relevant angle on it, right? Do you have relevant experience and the people around it that can help augment carving the business out? So I think that's one, right? So if it's a sector that, you know, it may look like a sexy, great deal and the value is going to be great, but have you done a business in this particular sector? So I think really being honest with yourself of, do we have a real legitimate angle here? I think that's one. I think another thing is just, you know, as Emily said earlier, really committing to the work that needs to go into really diligencing the business thoroughly, right? And also that's going to be, you know, not inexpensive. It's going to be a, you know, part of the deal. It's going to be a deal cost. And then I think really having what that transition plan is, you know, locked down, and what are the transition points that are going to be shared between buyer and seller, and having there be very specific, you know, I mean, it's going to be in a TSA, but really understanding how that's going to work. And I think having, whether it's internal or external advisors or people to help you with that transition plan, to help basically kind of quarterback what that transition is going to look like. And so oftentimes there are, frankly, there's been a lot of, kind of splintering people that have come out of, whether it's Platinum or Gores. There's a lot of funds that have experience doing this, but they also don't have the same level of kind of operational bench strength that the likes of Platinum have. And so I think, if somebody's looking to do that, or they've spun out or looking to do it, I think it's making sure you really got the resources around to actually execute and do the deal.
Yeah, thanks, Nate. Yeah, go ahead, Tom. I was gonna go to you next.
I want to circle back to what you were asking Emily about. She was responding about management. The question is, who's going to run the business? It's not the sponsor typically. So when the sponsor is meeting the management, especially if they can meet them in an isolated manner, away from the parent company officials, and sometimes that's done after it with a cocktail later. There's all sorts of management personas out there. Here's a business underperforming, and the guy that's running it, or the woman that's running it for 5 years, has lots of complaints about the parent company, the crybabies. And it's the same people who helped the investment banker put together the 17 things that can be done to make this business super valuable. Well, you've been there for 5 years. You didn't do any of these things. You couldn't convince the parent company that this was a worthwhile investment or use of your time. So that person comes off as suspect. So these are clues. This is one of the clues that a buyer would look for in the management team. Sometimes the management team is brand new. Maybe the parent made another stab at trying to fix this business, so let's bring in new faces. Those people might deserve a little bit more attention, because you really can't blame too much on them. They weren't there to create the problem. Especially interesting is the management of a third type that's been there a few years, but they have unfulfilled expectations. They're not the crybabies. They're the people who realize the parent company can only devote so much time to them, and they don't expect miracles. And they know that they're a tiny piece of the business, but they believe this business can accomplish this, whatever the this is. And when they talk about that, that's when you say, okay, here's some spark, here's some ambition. And especially if it comes around to how are these people going to be incentivized? Remember, the sponsors, especially the independent sponsors, in a position, he wants to convince the management to convince the parent company that he or she should be the buyer, right? And he hasn't got all the money in the world to do this. But at the same time, he's making an assessment. And when they start to talk about what management do you keep and how do you incentivize them? When the subject comes around to, will the existing management participate in the upsides? And you can see in their eyes, they like that idea. That's another clue. These are not the crybabies that have been around there a long time and blame everybody for everything.
Right.
That's a real red flag. So the meeting the management team has been critical in many cases I have seen, and it helps the sponsor determine how much of their own limited resources they're going to have to apply to this business. How many new C-level executives or none do they have to find and bring into the business? So they're going to make a bet based upon their reaction of a short meeting with the management team. But there's different classifications of management, and you can see them. You can see the differences when you talk to them about the business. Whose fault is it that you're in trouble here?
Right. Right.
And can I just add to that? I'll just add, while we're talking on the topic of leadership and retention of management, there is certainly, these are all very, very good points. It's what is the historical incentive structure? How is the performance of the business, the responsibility for the performance of the business historically, how is that presented? and is it, is there a blame situation going on? But I would say the other thing that there's only so much you're going to know. I mean, I think the one thing to bear in mind is that there is no magical way of if you did all these things properly in diligence, you'd really understand what's going on with the management team. There are certainly indicators. And what I would say, when I look at our portfolio companies, we typically find that within the first year, we change out at least one, if not the entire C-suite, in at least 75% of our businesses.
And within the first year, you said?
Within the first year. Sometimes it's immediately obvious. Sometimes it's immediately obvious that because this management team doesn't have the right capability to work in a sponsor environment versus working for a large publicly traded company. They may just not have the appetite. They may not have the capability. Often you'll see for the CFO role, you're going to see somebody who is a financial director or controller who's now boosted into a CFO role, and they really just don't have the capability to operate at that level in a standalone business. So I would just say, from a statistics perspective, we always anticipate, even if we think we like the team. I mean, I like to, I said this to you guys before, but I like to liken it to a dating process. Everyone's putting on their best behavior, and there's a bit of a love affair that often happens during the diligence process, which often can go sour once the deal has been closed.
That's really, that's some great color, on what to expect, within, I mean, it's a lot of change when a carve-out's purchased, clearly. So we have another question here from the audience, and I want to tie this in, and this may be, if not the last question, one of the last ones, because we're running out of time. But the question is, just given COVID, one thing, just generally speaking, I just want to get some perspective from the participants in terms of how you think that's affecting the market for divestitures in general, but also this supplemental question we've gotten from the audience is, when you think about earnouts or incentives, maybe from the seller, the corporate seller, what other conditional considerations are you guys seeing? Maybe that's a function of COVID, just to help hedge the risk a bit. So a two-part question on COVID. One is what is it doing with, is it affecting the volume of deals that you guys are seeing? And also, are there specific things that you're putting in place to help manage risk, related to the COVID situation? So whoever wants to take that first, go ahead. Oh, go ahead, Emily. Yep.
Yeah, so I can speak to the volume of deals, and I'd also love to hear, Nate's perspective on this from the other side. But on the buy side, we definitely have seen a change, particularly with the carve-out deals coming through. And it's obviously evolved over the past 6 months as the certainty and the comfort level has shifted, generally in the business community. But what we're seeing is, because of uncertainty, a number of processes have been pulled because the sellers aren't getting the value they need. So the processes that we do see going the distance are typically where the seller has an incentive to sell. Either they're in some kind of financial distress, they're highly leveraged and they need the capital infusion, or they may even be in a bankruptcy process. So I think what we're seeing is the volume has dropped to some degree, but where the sellers are serious, those ones are becoming, there are a lot more serious deals of those that remain. But what I would also say, another reason for that is, Nate talked earlier about the preparation that's involved. And I used to do this in my old role as an advisor, is help companies prepare to sell their assets from a financial and operational perspective. And there's a lot of work that goes into that. And you need to dedicate both from an investment perspective and resource perspective to prepare for that sale. And a lot of businesses, as we're all aware, have been distracted right now. They're just trying to stay afloat. So management attention has just been elsewhere. So what we're really expecting to see, you know, and we'll see if the markets bear this out, is we're expecting to see a real uptick over once we get past the election, because I think that's another dynamic that's putting a little bit of a chilling effect on the market. But we're getting a bit more optimistic about the pandemic. People are used to living with it. A lot of companies have stabilized, so they're starting to think about their divestiture processes more. But with the upcoming election, I think a lot of them are holding off. So what we're really expecting to see is in the new year a real kind of the floodgates opening.
Okay. Tom or Nate, do you guys want to respond?
Yeah, I'll comment really briefly. I mean, I think Emily hit it pretty well on. I mean, I think right now there's just a lot of cross currents that are still sort of going on here that provides uncertainty. And I think, you know, the carve-out scenario, while it may be, you know, of interest to a lot of corporates and they've sort of been thinking about something for a long time, I think that there's certainly a reservation on if it's not the greatest quality asset, you know, it's going to be a more challenging deal in the market. You know, I think that reverberates more broadly through just general M&A right now. I mean, I think if it's a good asset, you know, it's almost trading, you know, deals will trade almost at a premium to where they were pre-COVID. You know, if it's a good asset, just because there's scarcity value, you know, the dynamic inherently has more complexity and challenges, and usually there's dynamics that are a bit more challenging. So I think that it's kind of a more measured approach on how to navigate that right now.
Great.
Pradeep,
Yes.
I do think you're going to see an acceleration of divestitures in the next couple of quarters, and I think we can give the banks credit for causing that. So yeah, I love banks. Bankers have been generous and kind to borrowers that are violating covenants, not achieving their cash flow projections, becoming ever more leveraged with revenues dropping. Bankers can only manage to do this for so long. When they really start to put the screws to these owners and ask them to support the business better, I think you're going to see people say, well, maybe it's time to get out. And the banks haven't done that yet. I think that's coming.
Great. Well, I think we are coming to the end of the session. I felt like I was having a conversation with each of you, so it was super informative for me, and I really enjoyed the interaction, and I hope the audience members did as well. Lena, I'll just pass it to you if you want to say anything to close it out.
Yeah, I just want to reiterate that. Thank you guys, Pradeep, for moderating, and our panelists for your contributions. Definitely think that was an insightful conversation. I'd like to thank our sponsors, of course, for your ongoing support, and all of our attendees for joining us today. If you are participating in our Deal Connect, our one-on-one meetings, you'll want to log out of this link now and log into the separate link that my colleague Terrence Winters already circulated. We're doing a lot of webinars, so stay tuned for more information on that. We'll be posting today's webinar on our YouTube, so look out for that, along with last week's carve-out discussion on there as well. Again, thank you guys so much for spending time with us today and leading the way, and stay healthy and safe, and we'll see everyone soon.
Thanks, Lena.
Thank you.
Everyone.